traders, Gary Wagner here. Just around 10:30 in Honolulu, 4:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. Friday the 13th, 2013, and this is the daily report for gold and silver, our weekend review. And what a whipsaw week we've seen. Down $30, up $20. It's been all over the board trying to find a place. We do have an update. Currently trading, as you can see, $12.36, $12.35. Puts it up between $10 and $12 on the day. The low, $12.19.50. The high, $12.39.70. And as you can see, $12.36 and change. We are awaiting next week's FOMC meeting. I believe a lot of what we're seeing today is short covering in lieu of that meeting. Silver is trading up just over a full percent today, up around 20 cents. 1967 current print, 1926 on the low, 1985 on the high. We'll talk about silver a little bit more towards the end of the show. Most notably, in terms of the activity that we have seen in gold, is a pretty decent sized range, but it seems as though the market's going to basically close where it's open. And I draw your attention to this weekly candle. This candle represents 1 week in trading. The open is the bottom of the green box. The close is the top of the green box, the high here and the low here. You can see a dynamic range, but you can see that it's opening and closing roughly at the same point. It's called a doji. But when you take a look at that activity in terms of a straight 60-minute chart where we can actually see the activity, it really unfolds kind of interesting. And here's what I'm talking about. When we take a look at the 9th, this is where the week starts. So they're going to peg the open here, and of course here's the close. So the market opens on Monday, has a tremendous rise all the way up past 1265, meanders back down to around 1252, then slips out of bed. This is an area that we have identified, 1225, 1223 in that area, as a fairly critical support area. Market comes up, comes back down, and then you can see has kind of settled in this area, finds a little bit of support, builds a base just as it did right here, and then as of now closes slightly higher on the day, up about $10. But in essence, it has opened and closed in a very, very tight range considering the high and the low of this week. You know, as we get closer to the holidays, the volume tends to really contract, and you can really get major spikes in the market that you typically wouldn't get if in fact you had a normal volume. And I think that that has something to do with it. But I think that more importantly than that, what we have been witnessing is the fact that traders are definitely just uncertain as to the future direction of the Fed. Are they going to announce some kind of tapering next week? 1. 2, is the economy really picking up? We've seen the stock market really aggressively move to new highs, but has just recently, over this last week, come off of those highs. While it is much, much too early on a technical basis to say that this last move up has signaled an end or a cessation to the dramatic downside activity we've seen, we don't really have the evidence yet. But what we do have is a couple of interesting facts. And the first fact that I want to kind of point out to you is we're looking at a 720-minute chart. On the 720-minute chart, I've got a whole series of fib retracements, but the two that I want to draw our attention to are these two here. They both start from really the beginning of the only major rally that we had this year, 1180 all the way up to 1435, and here up to 1365. These are the two tops. When we do that and we plot our 76% retracement level, 1223 and 1240 are the numbers that we come up with respectively. Now, as this market came down on this last sell-off, there's no doubt we made this lower low. This is where we actually hit 1211, I believe, right in this area. So we hit just at around 12, comes up and then finds some real resistance just above 57, which is this mark here. I believe 65 was the high. But what's interesting is as it came back up, let's go ahead and blow this chart up now. But as it came back up, there's a couple of things that we noticed. First of all, we've got some real support on a technical basis at this 1223 area right here. The second thing is that although these are half-a-day charts, just as we have identified points in time in which we saw that three-river evening star develop, I wanted to point out the fact that here we're seeing a three-river morning star. Again, three-river morning star is simply where you have a defined downtrend. Well, we can say that it fits that criteria. Long red candle, absolutely. A star in the center, without a question of a doubt. And then a long green candle. So we've met all the criteria. The only thing that still has to be met in terms of it actually triggering a buy signal based on the candlesticks is that the following candle, meaning come Sunday or Monday, you would want to see a green candle with a higher high and a higher low, something like this, and this would be your confirming candle. A little too early to tell, but the fact that we have kind of landed here and found some support tells me that we could be looking at a potential bottom in the market. Now, for those of you who watched the first part of our Outlook 2014, it is on our website. I'll provide a link so that you can watch it for those who haven't. We talked about the fact that there's really two ways I see this market unfolding in terms of interim and long-term, and let's go pull up another chart for that. All I've done, I've pulled up our 3-day chart. This has our current Elliott wave count. We are looking at a bear count right now. Simply 1, 2, our long wave 3, wave 4, and it's my belief that we're currently in wave 5. Typically, wave 5 will have a 5 count. I've been able to see 1, 2. I show us in our third. We could have seen this could be the development of the fourth, and then one final clip down. On a standard Elliott wave correction in a bear count, we would look for the low of wave 5 to be below the low of wave 3. It makes a lower low. And so that what I would see is 3, 4, 5 hitting some sort of an area, whether it's 1180, which is the low before. 61% of the big move is 1154, and then go into some sort of an A, B, C correction, which would be a strong rally to the upside. Now, the way that we terminate this last fifth wave is really what I'm kind of debating and looking for some sort of clues, because we could see a standard zigzag in which we will see a new low in the market. The other model that we have been looking at has been simply a truncated bear market. We've talked about that, and on a truncated bear market, it's similar to a flat in that you get equal lows on the A and the C wave in a flat, you get equal lows on the 3 and the 5 wave in a truncated fifth wave or a truncated bear market. So in essence, what you would look at on that type of a model is we come down for 3, we get 4, 5 matches, but it truncates, so this could be the bottom, it could fall a little bit lower, and then you go into your A, B, C. Why is that so important? Well, the reason that it's important is we're trying to ascertain when this bear correction is going to go into its ABC, which is going to be a rally. We've had no technical indication that we should go from a bear count to a bull count, but in a bear count, that ABC is a nice rally, and that's something that we certainly want to take advantage of because there's going to be a good couple of trades in that particular unfolding of a B, C progression within the bear count. So we really need to determine, are we at the bottom, or are we going to see this market move lower? But my thought process right now is we want to be open for either of those two models, and as we get technical confirmation to be able to react on that information. Now, another piece, an interesting piece of information just kind of opened up to us. As you know, I always put a link up to the CFTC's COT report, Commitment of Traders report. It comes out on Friday. I put a link to the most current publication. Now, it is 11:45 here in Hawaii. I just received notification from the CFTC because I'm on their list that the new report came out. So I want to kind of pull that up so you can get an idea of what it is that we look at and what is really important to us. So this is the report now, and what I'm noticing more than anything else is that I tend to kind of draw my eye immediately to managed money, because managed money is going to tell me something that producer merchant is not. because regardless of what we see with the producer merchant long and short position, these are either suppliers or companies that need the end product. So they're really deferring risk. That's why they come into the futures market, is to take the risk away. But here is what I find interesting. Last week, we saw a huge growth in terms of managed money and the short positions that they had. But look at this. They have really unwound in terms of the managed money. This is short here. So they unwound over 5,000 contracts and added 650 plus contracts on the long side. So managed money is certainly unwinding their short positions and adding some long positions. Now, other reportables, it's not as important, but here we're getting the addition of 830 shorts to 1,300 longs being taken away. So those facts are certainly alluding to a possible bottom in the market. But there's yet another detail that's come across our eye in terms of looking at the markets. This is our 3-day chart that we have been using. It is in Japanese average format. It's going to lag behind. But the one thing that the Japanese average format will give us is in defined uptrends, you get the green candles, defined downtrends, you get your red. And we look for really the pivot points of where it goes from red to green, or from green to red to green, or green to red. I pay particular attention to these last two candles. They are green. To see them a little bit better, let's pull up a different 3-day chart that doesn't have our markings on it and our fib retracement on it, and that's this here. So we have a 3-day chart, and without a question of a doubt, although the market has essentially closed up a little bit, but really up about $12 from where it opened, we are starting to get a pretty nice rally. It's up about $13 as we go into the close. We're looking at $13.38 right now, but there's no doubt about it. When we take a look at this, we are back in green territory. Oddly enough, the dailies aren't showing that because of the way this market has traded down so drastically and up so drastically. But the 3-day charts are showing us quite eloquently that we could be looking at a potential pivot point in the market. We have gone green, and some of our other Western technical indicators are also pointing towards a potential bottom. Now, whether these indicators are showing us that because you've got a lot of short covering, realize we also short covered at the beginning of the week and pulled profits. So there's been many traders that are unwinding those short positions, especially right before next week's FOMC meeting. You know, this market's been under so much dramatic pressure, and we've seen such a whipsaw on the market this week that it's time really to kind of step back. That's why I've got this weekly chart up and take a look at the big picture. And on the big picture, here's what I'm seeing. First of all, we know we've got this ridiculous amount of support at around 1181. That's right in here. And wherever we look at a chart in terms of how it reacted in this area, we can see this being a fairly important number. The next real number is roughly at 1254, and we are below that. And this is the big picture, of course. But when we look at the candlestick type that developed out of the week, it's very, very doji-like, but it is almost what is simply called an inverted hammer. An inverted hammer is the same thing as a shooting star, depending on where it's found in the market, and it's simply the opposite of a hammer, in which you have a long tail above the real body. Hammer has a long tail below the real body. But it is something that we want to note in terms of a straight candlestick, especially since we identified the three-river morning star in our half-a-day chart. So when we look at it in this way, we can see there is some potential to look for some sort of a bottom in this market. However, I still believe it's just a little bit early. I want to see what happens on Monday, of course. Then we have the meeting starting Tuesday and Wednesday. So we could see some extreme activity as we go into next week. Now, when we convert our standard candlestick into the Japanese average, and they're always going to lag behind. We have not obviously gone green yet. It's going to lag behind, but you can see how these body sizes have really, really contracted. We now have a tail on the upper and lower end of this real body, and that is typically a good signal right before you're going to go to green. After a defined downtrend, you get a small body size in the red candle, and you start to get larger and larger tails. So that's also significant. As I said, have we terminated this last fifth wave? It's a little bit too early to tell, but some signs are indicating that potential. One, the second model that we would look at is simply going to say that we're going to go into that 4 out of 5th wave and then have one final drop down. We'll see how it unfolds as this year plays out. Now, when we look at our weekly silver chart, we're getting a very similar kind of a candle. The tail isn't as long, but we are getting a scenario in which we've seen a dramatic high and low for the week, and it's closing roughly unchanged. It's closing higher on the week. We do have a red candle. The key, as far as I'm concerned, is going to be gold. I believe that silver is going to follow suit with gold. On moves up, you're going to see silver typically outperform in terms of percentage gain. When the markets are moving down, I think that we're going to see silver outperform gold in terms of percentage losses. It's just that much more volatile of a market. In terms of support right now, I would look at 1940, 1945 as a support level. In terms of resistance, you got to look at about 2025. This has been Gary Wagner, wishing you as always good trading. We'll speak to you on Monday for another daily update and review. Have a great weekend. Bye-bye.